Chapter 10, Stockholders' Equity. In 10.6, we explained the effect of stock dividends and stock splits. Sometimes corporations distribute additional shares of their own stock to shareholders rather than cash. These are known as stock dividends or stock splits, depending on the size of the stock distribution. A stock dividend is additional shares of a company's own stock given to stockholders as dividends. A stock split is a large stock dividend that includes a reduction in the par or stated value per share. Let's assume that you own 100 shares of stock. Assuming a 10% stock dividend, you'll get an additional 10 shares. If you have a 20% stock dividend, you would get 20 additional shares. A 100% stock dividend, equivalent to a 2-for-1 stock split, means you will receive 100 additional shares. The 10 and 20% stock dividends are considered small stock dividends. The 100% stock dividend is considered a large stock dividend. Anything over 25% is considered large stock dividend. Large stock dividends and stock splits are declared primarily due to the effect that they have on stock prices. Let's say before the 100% stock dividend, your shares are trading at $40 a share. So your 100 shares are worth $4,000. After the 100% stock dividend, you'll have twice as many shares. It sounds good, but let's take a look closer. Since the company as a whole still has the same value, each share of stock is now worth 1/2 what it was worth before the stock dividend. Your 200 shares still have a value of $4,000, the same as your 1,000 shares before the stock dividend. However, each one is now worth half as much, $20 rather than $40 per share. Think of the company as a pizza. A 100% stock dividend is like changing an 8-slice pizza into 16 slices by cutting each slice in half. You are no better off with 16 half slices than with the original 8 slices. Whether it's cut into 8 large slices or 16 smaller slices, it's still the same size pizza. Total assets, total liabilities, and total stockholders' equity do not change as a result of stock dividends. When a company declares a stock split, we do not record a transaction. After a 2-for-1 stock split, the common stock account balance represents twice as many shares. For example, assume Canadian Falcon declares a 2-for-1 stock split on its 1,000 shares of 1 penny par value common stock. The balance in the common stock account is 1,000 shares times 1 cent equals $10. With no journal entry, the balance remains $10 despite the number of shares doubling. As a result, the par value per share is reduced by 1/2 to half a cent. 2,000 shares times half a cent equals $10. Having the par value per share change in this way is cumbersome and expensive. All records, both printed and electronic, that refer to the previous amount must be changed to reflect the new par value. To avoid changing the par value per share, most companies report stock splits in the same way that they record a large stock dividend. We account for a large stock dividend by recording an increase to common stock in the amount of the par value of the additional shares distributed. So you would increase common stock by recording the 100% dividend, 1,000 shares times 1 penny, you increase common stock by $10. Similarly to cash dividends, the stock dividends account is a temporary stockholders' equity account that is closed into retained earnings. This debit to stock dividends reduces retained earnings. So the stock dividend entry decreases one equity account and increases another equity account. So this entry does not change total assets, liabilities, or stockholders' equity. So here's an example of the balance sheet before and after the 2-for-1 stock split accounted for as 100% stock dividend. Beforehand, we had common stock at $10 and retained earnings at $29,500. Our total stockholders' equity is $100,000. We have 1,000 shares outstanding at a par value of a penny per share. Share price is $30. We did a 2-for-1 stock split, so we recorded $10 additional to common stock, but took away $10 in the retained earnings account through the stock dividends debit. Therefore, our total stockholders' equity did not change. It is still $100,000. Our common shares outstanding doubled to 2,000. The par value remained the same, but our share price was cut in half to $15. This illustration presents how to look at the effects of a stock split and a stock dividend. When you have a stock split, there is no change in total stockholders' equity, common stock, retained earnings, but the par value per share decreases. Think of your pizza here. With a stock dividend, total stockholders' equity still does not change. However, you are recording an increase to common stock and a decrease to retained earnings, and your par value remains the same. Recall that we recorded large stock dividends at the par value per share. We record small stock dividends at the market value rather than the par value per share. Again, it does not change total assets, liabilities, or stockholders' equity. You'll be decreasing one equity account and increasing two equity accounts. For example, the market value of Canadian Falcon common stock is $30 per share when Canadian Falcon declares a 10% dividend on its 1,000 shares of 1 penny par value common stock. After the 10% stock dividend, they'll have an additional 100 shares outstanding. The company records the following the transaction as listed below. Stock dividends. We debit the stock dividends for $3,000. The 1,000 shares outstanding each get a 10% dividend at $30 market value. So we debit it for $3,000. Our credit is to common stock. The 1,000 shares have a 10% stock dividend at 1 penny par value. We need to credit common stock for $1. The balance, $2,999, goes to additional paid in capital, the amount of the dividend that we're paying over par value. Remember, for the small stock dividends, we're recording it at market price. So the market price is higher than the par value. So you've got to make sure you've got that additional paid in capital listed, like you do when you record a purchase of common stock.